right, everybody. Welcome to this Stacks virtual webinar, and we're going to be all talking about the big topic of Bitcoin's productive era and how institutions are putting their Bitcoin to work, and yeah, essentially diving into this question of how we're turning Bitcoin from an idle asset into productive capital. So we're going to be talking about institutional strategies that are, evolving beyond just, buying and holding. We're going to be talking about the infrastructure that enables productive Bitcoin, and what comes next for Bitcoin capital markets. And yeah, this is of course like a very important topic, right? To just set the scene a little bit, or a fascinating topic, because Bitcoin has really evolved a lot as an asset. Of course, with the chain not having changed, right? I mean, initially, the big problem was trading, right? It was very difficult to trade Bitcoin, and some of us maybe remember the days of Mt. Gox and all the difficulties that brought. But that was then solved, right, with very good exchanges. And then the problem kind of became custody, right? How do you custody Bitcoin? And institutions had to use hardware wallets and clunky solutions. And then there were custodians, right, to sort of solve that problem, and Bitcoin evolving to the next stage as an asset. And today, that kind of question is, how is Bitcoin going to become productive? How is Bitcoin going to generate yield, at scale? And yeah, that's what we're going to be talking about. I mean, we've got a fantastic lineup to chat this through. Of course, Alex Miller is here, CEO of Stacks Labs. Then Neil Chopra from Fireblocks, where he is head of strategy and financial markets, and our dear friend Gordon Grant from Bitwise, where he is portfolio manager and head of derivatives. So maybe as a way of introduction, just want to ask you guys each the same question, right? What do you think is the biggest thing that's changed over the past year that's making institutions think differently about making Bitcoin productive? And maybe you want to start with that, Alex.
Yeah, I mean, I think every day that goes by, Bitcoin just gets a little more ingrained and set into the financial system across the board in a lot of different ways. And I think every day that happens, it just gains that little bit of acceptance. Companies realize it's not going anywhere. There's obviously been greater instability around the world in general, and it's just had a lot of folks looking in a lot of different places for more options. And at the same time, you're seeing a lot of great providers, like some of the folks on this call with us today, who are seeing that opportunity, and so they create more additional products, right? And I think, as you were hitting at, right, like it was a really big lift when your only option was to buy and hold Bitcoin in a hardware wallet that you needed to have the expertise to set up in, right? But if you have great custodians now and great services like, say, Fireblocks, and you can deploy into different derivative products and things, that gives you a lot of options of how to do it in a way that's actually compatible with you, even if you aren't maybe necessarily a fully crypto native firm. So I think it's both. You're seeing it from the demand side of companies just wanting more options on things, but equally as importantly, there's more offerings out there that actually make it possible for them to go into it. And that just kind of creates a flywheel for it.
Yeah, excellent. I mean, Neil, do you want to take the question as well? What do you think is the biggest thing that's changed? That's making institutions think differently.
Yeah, Alex, I kind of echo everything you said there, and I love big macro guy. So if I kind of zoom out as well, I think this concept of like risk profile is critical, and I think that is continuously developing and being better understood. If you look at traditional markets, you have risk profiles around counterparty settlement risk and things of the like. There's not really a technology risk element that people have understood, baked in, and now priced. And I think that's going to be a big catalyst for us. If I look at what happened during sort of the tariff announcements last April, what we kind of saw was a very immediate shock across FX and rates markets that then parlayed into commodities. We're seeing it in equities as well. And I think where Bitcoin is kind of sat within all of that is just kind of a catch-all as liquidity starts to swing back and forth. And I think the ETFs that have been launched have now provided easier access for liquidity to get into Bitcoin and crypto more broadly. And as we start to get these new vehicles, as we start to build out additional capital markets products around this, the ability to actually have some form of utility with these assets, we're just going to continue to see this broader strengthening, I think, of institutions wanting to step in because there's actually some form of utility of holding it, not just saying, hey, this is a hard asset, digital gold, hedge against inflation. Yes, it's all those things. But it's also a lot more, especially from a Fireblocks perspective, just seeing wallets and digital assets kind of taking over the narrative at a lot of traditional financial institutions. Knock on wood, what we see happens with Clarity over the next couple of weeks, but just a lot of positive catalysts, I think, out there in the market that is just helping us really all in real time define what this can and could look like.
No, awesome. And then also really curious to get your perspective, Gordon. I mean, you've been focused on Bitcoin yield for a long time, I mean, through the highs and the lows. What do you think specifically has changed over the past year relating to institutions?
For me, it's a little bit more of a downer story in terms of making Bitcoin productive because the alpha is sort of bled out of the hodl. And so folks are now looking at Bitcoin reference 65,000 and seeing it at the same level it was in the spring of 2021. And that's fairly sobering, particularly if you came into the asset class within the last year when there was a great degree of enthusiasm about the next phase of Bitcoin adoption, all of which has transpired, but it hasn't corresponded to an augmentation of price. And therefore, with price flat to where it was 5 years ago, and with price significantly down from last year, institutions that have made the case that BTC needs to be a portion of their portfolio, therefore have a greater onus to define productivity as alpha. And alpha right now is apparently not in a pure hodl. So I would say on the margin, right, having been in yield and derivatives focused yield for quite a while, the same set of cohorts have remained steadfast adherents to the premise that BTC can be productive. But the new entrants to thinking about Bitcoin as a productive asset and asking how can a derivative strategy or any other kind of strategy work for them are those that have accepted the slightly more sobering reality that Bitcoin is 65K today and not 125K, and therefore need to justify it and are coming to discover perhaps forcibly that it is a wonderful asset as productive capital. But perhaps if price had continued to appreciate, they would have been less likely to do so.
Yeah, and I think that's a really, really nice bridge, right? I mean, Alex, too, because we hear a lot about this. People talk a lot about making Bitcoin productive, right, or productive Bitcoin. But what do we actually mean by that, right? Maybe from the Stacks perspective.
Yeah, I think when people talk about that, you can hear it two different ways. Some people, it just means, hey, can I get more money for my Bitcoin on top of it? Which, like, obviously you want to earn yield on something like that. But I think when you look under it, right, what's the reason you get paid a yield for something? It is because you're doing something with it that's creating value for someone else in it. In the case of Stacks, we're obviously launching right now. We're about to have the hard fork for our new Bitcoin staking consensus mechanism that lets you earn a 3% yield on top of Bitcoin that's becoming part of Stacks consensus. And in our case, right, it's providing a lot of value to the underlying Stacks network because it's bringing some of the economic security that allows Stacks to create all of and have all of these more complex smart contracts and faster functionality on top of Bitcoin that's secured fully by Bitcoin. Because I think one thing that's been very clear is, Bitcoin is going to remain the asset layer, right? It's absolutely the most powerful. It's the foundational element, I think, of crypto, but we're not going to be introducing full programmability on top of Bitcoin. You've seen the battles back and forth time and time again across it. And I think, that simplicity on the Bitcoin layer has a lot of advantages to it, right? And keeps it very secure and very stable. But we need to have kind of the greater functionality that people want and expect from other ecosystems like Ethereum, Solana, whatever else, on top of something that is that kind of on top of Bitcoin, on top of the fundamental asset of it. And so that's really what we're trying to do with Stacks. And with Bitcoin staking, we're solving kind of both sides of that problem, which is both how do you help provide the security for the network, but also how do you provide that productivity and that return to people who are holding Bitcoin for the long run.
I would also
go for it.
Maybe adding to that as well. I think holding for the long term is a really key element there. I think where we're going to start to see some really interesting traction is around Bitcoin as a collateral asset. Because if you can now hold on and sort of realize and appreciate those gains over time, but get access to and unlock capital using that particular asset, at least from a retail and institutional perspective, there's a ton of value there. And what I think we're seeing now is, I referenced clarity earlier, is this concept of saying you have traditional assets and markets, you now have blockchain-based assets and markets. We need market structure in the traditional world to translate into the on-chain world. And once we have that defined, once we have those different market participants and a clear sort of role and function for each of them and what it means to actually post, move, transfer collateral, that's where then around that ecosystem, Alex, you hit the nail on the head. Bitcoin is the base digitally native asset for blockchain ecosystems. Full stop. The dollar with stable coins will also be one of those, but we're also seeing a narrative that Bitcoin's going to be used in monetary reserves for a lot of central banks as well. And so if that's now the one consistent digital layer that connects all of these different ecosystems, you now have to figure out where and how those ecosystems start to connect and how do you start to actually put assets on chain. So it's one thing to say I can access yield products. I think that's the starting point. Collateral and yield access for more of the retail and institutional in the short term, but to actually unlock the true value and potential of not just Bitcoin, but I think the technology stack that is blockchain, we really do need this concept of market structure to translate so that everybody is comfortable and understands what they can and can't do in this space.
I think that's a really, really nice point, right? And kind of, collateral begets yield in a way too, right? When an asset can be posted as collateral, becomes productive capital, right? You can generate yield with those borrowed assets. I mean, that's of course something that we think a lot about at Zest Protocol as a Bitcoin lending protocol. But wanted to pass it to you as well, Gordon, because this question of Bitcoin collateral is quite interesting because it creates yield in these different ways, right? You can borrow against your Bitcoin to generate yield on the borrowed assets. I mean, in some ways, Sailor is also creating yielding instruments, kind of using Bitcoin as capital or collateral of some sort. You're of course super experienced in the derivative space, where in a way Bitcoin is generating yield as collateral in some way. But maybe you can shine some more light on that.
Yeah, for sure. Well, think about, right, when you enter into a derivatives trade, let's say you sell a call option, which is what I do some of the time, and you post Bitcoin as collateral, let's say into a tri-party wallet or perhaps a non-custodial wallet, and you are the pledgeor and there's a secure party, it's functioning as capital because it's a surety pledge for financial performance in the event that Bitcoin goes up beyond a certain level. And what are you really doing when you sell that call option? You're providing kind of a right tail insurance, right? Someone wants to get exposure to a sudden increase in the price of Bitcoin. You are providing that to them, and you're posting Bitcoin as capital that functions as collateral, which is not the way most people think about an options trade, but indeed, it's probably the most basic form. You're not lending it, you're not converting it, you're not doing anything other than using it as a pledge, right? To represent that you have the asset. You can make that manifest cryptographically as well as kind of traditionally, and you're entering into a contract, right? Not a smart contract, but a paper contract or an electronic version. Where it starts to get more interesting for me as another form, a transmuted form of capital, is something that has been often overlooked probably by a lot of the on-chain community because it's so not Bitcoin, but it's the in-kind creations, right? You take your Bitcoin, you go to an authorized participant, and you turn your Bitcoin into a spot crypto ETF. Take your pick, BitB, IBIT, FBTC, whichever you want. And all of a sudden, it can sit in a brokerage portfolio. And then it could allow you to do other things, right? Physical Bitcoin, pretty hard to use it to collateralize a trade in a highly correlated asset. Let's say like a publicly traded miner that holds a significant portion of its balance sheet in Bitcoin and has a 0.6 correlation to Bitcoin over some long run horizon in a statistically robust fashion. Hard to do, but as soon as you transmute your Bitcoin into that spot ETF and it rests with an equity prime broker, you can do that trade all day long, right? If you want to. You can also trade totally uncorrelated assets where you could just simply borrow against Bitcoin at the overnight bank funding rate plus or minus a spread and stick it into a fixed income product, which you could do if you were borrowing against your Bitcoin as collateral either in a CeFi or DeFi way, but it suddenly unlocks Bitcoin because it lives within the traditional financial system in a more integrated fashion. And I think the ultimate extension of this is going to be, in terms of making Bitcoin productive, you may not even have to do the creation, right? You show up, you have it, someone else does the creation for you. They just tell you what you can do with your Bitcoin. And I think that the true prime services providers, and CCPs, right, centralized clearing counterparties, are going to unlock that next phase of Bitcoin. And then it won't really matter, right, whether you want to be talking about Bitcoin as productive on-chain collateral, Bitcoin as collateral inside a broker-dealer equity securities construct, or indeed Bitcoin as collateral for swaps and direct contract market transactions, like in the FCM space, futures commission merchants, where under the recently announced changes, Bitcoin can actually collateralize something like CME futures and futures options, which is quite a welcome development and something that I don't think gets enough airplay.
Yeah, I think it's a great
it's
point by Gordon.
Go
I
for it,
think
Alex.
it's one thing actually that a lot of on-chain people miss is that you're not just competing against other on-chain protocols when it comes to interest and attention. Most people, especially institutions who hold large amounts of Bitcoin, they don't care. Like, they certainly have a lot of requirements around the security, around the custody, around their risk management models. But at the end of the day, they don't care about whether it's on-chain versus off-chain. So if you want to build something that is on-chain, it actually has to meet their requirements and look more attractive than what they can do by like going into an off-chain derivative protocol, using it simply as the backing.
Yeah, and we know that there's like a wide range of different yield options kind of available. We sort of see that in the conversation now. Maybe just to shift the conversation a little bit, like what do we think that institutions kind of care most about, right? To really get scalable Bitcoin yield that people are not just going to generate on like maybe 1, 2, 3% of their Bitcoin stack, but on like the full thing. And I see you nodding already. Maybe you have a good take on this. I mean, you have a lot of customers who are thinking about this question. So yeah, take it away.
Yeah, no, I wouldn't say I have a great or a smart take on this. I think it's if I look at this in the context of any other asset and any sort of portfolio allocation, goes back to what I mentioned earlier, is what's the risk profile? How are you looking at accessing Bitcoin yield? Is it simply pledging it or sending it somewhere and that person goes off and does what they do? Is it native on-chain yield through some form of sort of programmatic generation? Is it wrapped Bitcoin that goes somewhere else? I think all of these different constructs inherently have their own risk profiles and parameters. And so it's really going to be up to the market, to be perfectly honest, to say, in order to pledge or send my Bitcoin or lock my Bitcoin in option A, B, or C, I need to understand the risk profile of what's deriving that yield and how much yield I'm ultimately getting from it. If I can just, again, put my Bitcoin into Coinbase and get some cash from it, or USDC, and then go invest that in BITL, and I have 4% and I still hold my Bitcoin returns over the long run, then ultimately these protocols are going to have to yield more than that, because that's the baseline, quote unquote, risk-free rate that they're getting benchmarked against. And so I think we still need to see how these different protocols and yield products evolve, but it's all going to come down to risk appetite. And then, like any other investment thesis, you need to understand the risk, benchmark that against your risk-free rate, and then decide if that risk is worth the return that's being ultimately offered on this. Again, there's just a bunch of different complexities or parameters that need to be evaluated around technology risk and ecosystem risk that we don't necessarily have in traditional markets. So I think those books will ultimately need to be written by somebody or some group of folks.
Yeah, and we'll get there. And I think especially when Alex and you mentioned just risk-free rates on Bitcoin, right? I mean, it's something that very much exploring. Stacks, of course as well, right? With the Bitcoin staking launch coming out. Do you have any sort of thoughts on how maybe DeFi can set this risk-free rate in the space of making Bitcoin productive?
Yeah, I mean, that's absolutely our goal, is to try and come up with a good risk-free rate. Specifically as we see it, by you keep the Bitcoin in your own custodian under your own keys. You put it in a simple time lock, but there really is no additional risk beyond however you choose to already kind of custody and maintain your Bitcoin to it. I think obviously any kind of institution is going to be that's, I think, often going to be their number one risk and concern, right? Like you're willing to risk 100% of your Bitcoin maybe on some kind of like exotic financial strategy, but you don't want to feel like you're taking the risk for it of like where you have to do it and sort of like this other excess risk in other places. And again, because at the end of the day, you can go and you can just go buy like an ETF through a traditional brokerage where your risk management team knows exactly how to think about that and evaluate it, and you're offloading all of that other complexity and risk to it there. So yeah, that's absolutely our goal, is like, how do you come up with something that's an attractive rate and but doesn't require people to kind of have to think through like, what does it mean to, take on the smart contract risk or the bridging risk of all these different things. And then, ultimately our goal too is, yeah, let's layer that in with lending as well, right? So you can both be earning a yield from what you are putting into the protocol there, but you can also at the same time be using that same Bitcoin as collateral to take a loan against. And now you're actually probably able to earn more on the Bitcoin, even than you're potentially paying on your funding rate for it.
Yeah, I mean that's what we want to facilitate, right? On the Zest protocol side, on Stacks very much so. And yeah, awesome. I mean, maybe just one thing to touch on too, right? I mean, Gordon, you've been in the space for a very long time, and maybe briefly, like, what do you think are what's the most common misconception about earning income or making Bitcoin productive?
Well, I tend to say, as it's been articulated by other very intelligent, experienced folks, you got to be careful what you call yield and what you call income, and what I think of as static return or alpha. Those are all slightly different things, right? If you really lend out your Bitcoin for a fixed term at a fixed rate, well, that is yield of a true sort. When you think about focusing on what I do, which is an options strategy, I often like to classify that as options income, right? Or volatility alpha, something that helps people understand that there's not a recurrent coupon, even though there can be something flowing to you, as the holder of the asset. And then the question is it really alpha, or is it income, but income that's somehow correlated to the distribution of the returns of the underlying asset? And it is important to distinguish between those. For instance, if you do a programmatic covered call strategy that sells 10% out of the money options every month, just at the beginning of the month, and that's not what I do. I do very much the antithesis to that. Well, that strategy probably is not alpha. It's actually a lot of it's negative beta, because you're going to do very poorly if Bitcoin just persistently rallies over time. So you're not really making your income from an uncorrelated source. You're making your income from a strategy that is negatively correlated to the long run impetus in the price of Bitcoin. So it's less about a misconception. I think but it is, people hear, well, I could get yield if I just sold call options on Bitcoin, right? And we even have products that have yield in their names, right? The Grayscale Premium Yield Fund or the BlackRock Bitcoin, yield or income fund. And you have to really pay attention to the label on the wrapper and see what they're doing. The BlackRock product, interestingly enough, is targeting yield, which is really a mix of return on capital and true options income of 15 to 25%. Now, where do you get that type of income? You get that type of income, as it says in the prospectus, from selling 30 delta options on Bitcoin, which means that you only get locally about 70% of the price participation. That's not falsehood in advertising. You just have to read what's on the label and understand, are you getting yield? Are you getting income? Are you getting alpha? And make sure it's what you want when you make that decision.
Yeah, amazing. I think we're almost coming up on time here. So just wanted to thank you very much for this great exchange, great discussion. And yeah, we'll be back with many more of these over the coming months. So keep your eyes out on the Stacks X and YouTube channel. And yeah, see you guys next time. Thank you very much.
Thank you.